Good morning and welcome to another episode of Curious Investors. I hope you're curious not only about investing, but life itself. I've got all kinds of curiosities, even in this small screen. There's a little board over here, there's a baseball player, a pinball machine, all kinds of things that create curiosity and stir the soul. And investing can just be one of those things that doesn't have to be everything. So before we kick off, let's take a look at the disclaimers to make sure you know that there's great risk to all that you do. Curious Investors is for your safety. There's these disclaimers. If you wish to remain unidentified from the recording, please remove your name and your face from the screen and the views. We have no crystal balls. This is strictly our opinions. Stock investing includes risk. You will lose money if you invest in individual stocks. They fluctuate in price and you will lose principal. Dividends aren't guaranteed. This information is not a specific recommendation in relation to any investments. However, it's just a general presentation. Any reference to specific securities are for illustrative purposes only. And today we're going to talk about some specific ones for which you cannot invest to do the same thing we talked about, because all these illustrations are in the past. And when you invest, you're looking to the future. Content provided at this event is for general information only, not intended for specific or active recommendations for any individual, and that includes you. All indices are unmanaged, as a matter of fact, cannot be invested in directly. Any economic forecast set forth during this event may not develop as predicted, and there can be no guarantee that any strategy will ever work or ever be successful. There are no guarantees in life, so just wrap your brain around that and get along for the ride. These thoughts and opinions are those of Gimbal Financial and do not represent the views of LPL Financial. Securities offered through LPL Financial, which is a member of FINRA and SIPC. Investment advice offered through Gimbal Financial. We are an registered investment advisor, and we are completely 100% separate from LPL Financial. We are our own going concern, and we are thankful that you'll take the time to hang out and watch things such as this. Have a great day as we jump into this idea. Let's just jump back in a little bit where we started last week. Let's talk about the idea that there is the possibility to start your investment trades by limiting risk and understanding what risk really is. If you didn't join us last week, you can jump in on the Gimbal Financial website or our YouTube channel to get the specifics of what we discussed. Last week, we talked about the idea of using a lead to lead your dog or a leash to let your dog lead you. And with the lead, you put a little bit of pressure around to direct them where you want them to go. And we were using this example of the pressure to limit where your stock portfolio would go should things go against what your original thoughts were. So that's how we started last week. And this week we're going to talk about using the lead to help your portfolio, specifically minimizing risk, because you want to start with understanding the risk before you jump into any investment, and understanding the risk will enable you to manage your portfolio much better than just jumping in and hoping for the very best. All right, here we go. The first thing you want to do is appreciate the math of a loss. We talked about last week how that if you let a loss go to 10%, that 90% of the capital you have left will take an 11.1% increase to get back to just break even. And should you let a loss go to 25%, you're going to have to earn 33% on that 75% of your capital that you still have available. And we were just emphasizing the idea that it's much more likely to come across a 11% gain than a 33% gain. As a matter of fact, you cannot get an 11% gain without having first got an 11% gain. You with me on that? So before you can use that lead to lead your portfolio, you got to be comfortable with the idea that the math is working against you if you let your losses run. And so that lead, you need to tuck on those investments that are not going in the direction you anticipated. And I'd even throw out the idea of specifically writing down, if you're getting ready to buy a stock, what your expectation is dollar-wise on the upside and how much you'll let it go down negatively, so you'll be realistic with yourself as you go into this thing. You're going to be fortunate as you get started with this if you're right 1 out of 3 times. And so that means you can't let those losses build up until you've got better expertise in making these sorts of decisions. All right, the second thing, so firstly, you want to understand the math of a loss so you can understand why you don't want to let your losses go. And to do that practically, you can set an established rate of return you're expecting and a downside risk. So if you're going to let your portfolio drop down 10%, then you definitely want 2 times that, or 20% increase, to be your objective on your goal. You always want to probably go 2 to 1 when you're talking about risk and reward on those things. Secondly, you need to appreciate the trend of the market. The market is going to drag most stocks the direction it's going. And so if you think the market is going up or down, it's going to affect what you're going to realize when you decide to buy an individual stock. So if we just use the current market and look at the NASDAQ here, this is the broader market of generally high-tech stocks, and this is not the current market. Let me go to the current market. I'm going to stop sharing for a second. It's not cooperating with me. Here we go. Let's share this again. All right, the current market, if you were going to say which direction is this market going, really all you need to do is pick a couple of these tops here and draw a line. Let's pick this one, and I'll put on my tool here that lets me draw a temporary line. So if we pick this top right here, went to this top, and these tops right here, that's going to give you a general trend of which direction this market's going. So it is currently trending upward in these last few months, and that would be represented by these other lines right here. These are called moving average lines, and they tell you the average price of the market, depending on which time horizon. This red one's like the last 50 days of the market. This black one is the last 200 days of the market. So the trend is upward. So that would give you kind of a green light to go ahead and look for some individual securities that might fit your goals. So you first of all need to understand the math of a loss. You need to understand the direction of the general market. And then thirdly, you need to appreciate the trend of individual stocks. And so when you look at an individual stock, so earlier this year, this was one of the stocks that everybody wanted to own. And as it refreshes here, we'll talk about it. This again is not a specific recommendation to buy, sell, or hold. This is just an example of historical things. So earlier this year, if you connected the tops on this thing, this particular stock, Zoom, was trending upward. But if you look at it right now and connect the tops of the last few weeks, it doesn't look the same way. It looks differently. And I'm not saying that this stock has topped out. I'm just saying that you probably don't want to jump into this stock right now if you're looking to limit your downside risk to 10%. And so the direction of this particular stock does not look like it's one that would warrant you jumping in with your money today. And so understanding the direction of the market and then looking at a specific stock will help you to make better decisions, because if this is going to be a winning stock going forward, it's going to curl around and start pointing upward where you'll have a chance to get in the stock while it's moving upward. You want to enable yourself to have the highest probability of success without risking too much money. There was an old song back in the 70s, I think it was called The Gambler with Kenny Rogers, and he said you need to know when to hold them, when to fold them, when to walk away, and when to run. And that's what we're going to be talking about, is when do you buy a stock, When do you hold on to that stock? When do you fold it, like in the gambling? When do you let go of that stock? And when do you run away from that stock? And so those things will help you to understand what's the best direction to go moving forward. So what I'd encourage you to do is you're sorting through those three ideas is to make sure you understand the math, understand the direction of the market, and then figure out the stock that you're particularly looking at, is that you kind of use a red, yellow, and green light on all three of those characteristics. Am I green? Do I understand what I'm risking? If I don't understand what I'm risking, that's a red light. If I'm starting to understand what I'm risking, that's yellow light. But you don't want to risk money in the market unless you fully understand what you're risking. And that risk probably is best if you write down, this is how much I'm going to risk. The market, again, if you give the market a red, yellow, or green, we can go back to the general market and change the dates here. We're going to look at the NASDAQ market on this one, and I'm going to change the date to April 11th of this year. And now I'm going to share my screen with you. And so if we have kind of three distinct markets that are going on here, we have the one that was the end of 2018 that just went downwards. And it probably, you could have identified it was going downwards right about here and saved yourself a little bit of heartache right here where it's trending downward. So this one probably would have been maybe yellow. I'd have to look backwards to see what was going on right here, but definitely right here you would have gone to yellow on your thoughts, and then red on this day right here would have told you, hey, I need to look out for this thing. It's more technical for another day, but you probably would have been green about right there, about that day right there. It would have been safe to come back in with some of your savings to get it invested for you. And then this thing was trading sideways for a while, and right about here on this day. So this, again, you would have had a green light probably from here to here, and then probably started trading yellow from maybe here into here. This is hard. It's hard to say because we're looking backwards here, but looking backwards, you can identify there are clearly trends here. And then you had a smooth sailing marketplace that went into the last quarter of 2019, much easier. And then all of a sudden, when we got into the winter of this year, you had this time that it would have gone yellow and red probably just in a couple of days right there. And again, this thing probably went green over here. And we can talk about this in another time of how to identify those situations. Let's see if I can get you back to today. So when it went green in the April time frame, would have been right about here where it went green. You've had a really kind of smooth sailing period until right there. And personally, I was getting smacked around with my stock trades. And this is, even though we're hitting new highs over here, this is still a really difficult market compared to some of these other ones we saw over there. So you need to formulate whether you're going to say you're in a red, yellow, or green market. And I would say you're probably in a yellow market right now, which means you just need to exercise caution as you're making investment decisions. When you go to a green in your mindset, then you can start pressing the gas on your investing and making decisions based on what the market is telling you about the underlying stocks. If you go into a yellow market, like what would have happened over here, and then you went into a red one right here, what you're going to want to do is take money out of the market and be much more cautious. And so if we're going to use an example of you getting invested, let's say you have $1,000 to invest in stocks, and then you're going to say, I'm going to put that $1,000 in 4 stocks, so $250 in each. If you're in a red market, you're going to want to put 0 in any of them. if you're in this market right here, you're gonna be tempted to buy, but you're gonna want to wait until all this selling settles down. And then right here, when you would go into more of a green market, you can begin to consider, how do I get my toes in the water on this thing? And so when you're in the red and yellow market, what you're going to do is build a wish list of stocks that you'd like to own, and then begin to consider what price would make sense to get those, so that you won't hit the math of getting stopped out of that or losing money on the trade. And there's times when you can trade much more safely than others. And in those times is when you want to be ready to have a list of companies that you'd like to own. And so what you would do is, if you have 4 stocks of your $1,000, you're going to put 250 in any one of those at any given time. Is that the first one that gives you a signal that you'd like to buy it, is you buy $250 worth of that one. And then immediately you establish what your gain would be on that. If you were going for a 10% stop, you're going to risk $25 of your 250. And then if you're going to risk $25, your expectation of a gain should be $50, twice that, so that your 250 would have a 2-to-1 risk relationship there, that you're going to have a stop loss of $25 and you're shooting for a gain of 50 on that $250. And so when you make that first purchase, that purchase is going to indicate whether you should take the next $250 and put it in the market, and the next one. And as those situations get established in your portfolio, then you'll be able to look at the portfolio on a daily basis and let it tell you what your specific market is. Your market is not going to be the NASDAQ, because you can't invest in that accurately other than using some exchange traded funds. But if you're going to put money at risk and try to buy individual stocks, you're probably hoping for a little higher expectation than what the general indices are going to do for you. So put your first stock in, $250. You're hoping for that to get up to $300 or stop you out at $225. That's the math. That's the situation. So as you're picking a company, you're going to have to pick a buy price as well. And just to use kind of a starting place for you, if the company is proper, it's going to be one that's going to be probably approaching a new high. And as you buy near the new high, then that's where you're going to lock in. And you don't want to just broadly go out and buy stocks at new highs. We will talk about this in other times. You want to wait for the stock to settle down so that the lines will be shorter on it. All right, we're going to go look at some examples of stocks now. And let me get a couple of these up on the screen. And I went back a number of years to show you that this is kind of timeless. The math that we're talking about here is kind of timeless. And I picked winning stocks because they were just stocks that came to mind. But you can lose money on winning stocks if you're not careful in how you make your decisions. So the first one we're going to look at was a winning stock many years ago, and it's kind of an okay stock. You're probably just as well off buying the S&P 500 now that this stock is so broadly known. The stock is Walmart, and the time that we're going to look at it here is December 30th, 1986. And so we're going to try anyway. If the system, my computer is moving much slower than usual today, so we're just going to see where this thing takes us. All right, I'm going to share this with you, and let's just talk through it. So Walmart in 1985 and 86 had this tremendous run up, like we were talking about. If you connect these highs and you say, which direction is Walmart going? It is going in the right direction. Let's take a quick gander again at the market to see which direction it's going, because we wanted both of those to be in our favor. We're going to use S&P 500 to see which direction it's going. And it had a nice run up itself, and then it's trading sideways here. So if we go back to Walmart and understand what the underlying market is doing at that same time. This did pretty much what the market did. The market's going sideways. This seemed to be a leader at the time, and if we waited till 1 penny higher than $49.50 to buy this thing, we want to own this one, but we're not going to buy it until it's a penny higher than $49.50. See what happens, and if we buy it, we'll take $5 off and say for that 10%, we'll say we sell it at $44.50. And so I'm going to add a day at a time here for you, and let's just see what happens as we move forward with this stock. We're not buying it until it hits $49.50. And that green dotted line across the top is where we're doing it. So we haven't put any money at risk yet. We're just holding off to see if this thing can go to that $49.51. So even though I would have maybe wanted to buy a Walmart way back when I first started this thing over in this time frame here, I'm waiting for it to prove that it's going to go upward rather than wait on it to go upward and have my money at risk when otherwise I'm sitting in a safe savings situation. And so here we go. It might have hit the $49.51 right here. Let me take a look. Yep, it hit $50 a share on January 20th. So now we have probably 50, or what would that be? 5 shares of that. We have 5 shares of $50 stock. And now we're going to see what happens as we move forward to see if we'll hit that 45 and lose our Walmart stock. Again, the market is trending upward. We had a little bit of a pop there. We've been excited that day. But to get to our $300, we're going to, our 300, we're going to have to get to 60 on this stock. And we want to get to 60 before it goes to 45 is kind of the goal. And so I'm just clicking one day at a time of what actually happened to show you how you might have experienced this particular trade. Back in the day when this would have happened, it would have been a lot harder for you curious investors to do this because there were a lot higher commissions. You can go out and find accounts that charge close to nothing for transaction fees and begin to trade this simply with the risk of the market and not the additional risk of paying a commission to the broker. We've now that we're up over $52 a share, well, we've dropped back down. I was getting ready to tell you that we've got a little bit of a cushion on our original $49.50 stock price that we purchased it at. We may not be able to go through all the examples I have as this thing is moving slower with this video than it was before. But with Walmart here, you can see that we finally kind of got a cushion that we're up to almost 53. And our stop is at 45. So we've still got a lot of downside risk before we lose this stock. And it continues to work its way up, which is an ideal situation. So if this was our first stock that we ever bought, we would think we're geniuses. And it is now trading at $58 a share. And we're in it for just a little over 2 months now. And we're getting closer and closer to our target price of $60 a share. And we'll see what happens here, see whether we get the stock to continue in our direction or whether this one was one that we learned how to trade on our very first one. Just because you have success on a trade doesn't mean that you're excellent. You need to learn these rules and execute them on a regular basis. So here's the $60 price. It hit it before it hit the 45. And so then the decision you have to make is, am I going to sell it at 60? Well, if your goal was 60 when you originally bought it, then you probably should stand with that. And maybe you sell half of your Walmart at 60 and let the other half go, and then raise what you call your what's called a stop loss in case the stock goes against you and starts dropping. You might raise your stop loss to your $50 a share price so that you'll give it plenty of room to go with the market, but you'll never lose money on that second half of the trade that you had there. So I'm just going to give this a few more days to see what happens with this stock, but say we took a half a profit there and we've got half of that in with a stop loss at 50. we can just let our Walmart do what it's doing here and see what happens. It looks like we're at the mid 50s again. It makes us feel like, oh, we came down pretty low and hard that day, and it would make us feel like we were going to lose money, but we've locked in half of a profit on this one and put our stop at the $50 level. Just because you have a stop order in it doesn't mean you're ever going to sell at that price. When you have a stop order in, it simply means that when the market touches at that price, my order becomes what's known as a market order, and it will then execute at the next price, whatever price that is. And sometimes stocks will do what we call gapping, and maybe Walmart announced something horrible and it gaps past that $50 stop price and opened to start trading at 40. You wouldn't get 50, you would get something around 40. So that's that risk that's out there anytime you invest. And we only hit 60 so far on this thing for just a couple of days. So by having your order in, you would have executed and been out of half of this stock and let the other half go. And it's trying to go to new levels for you, but you can see how that's working out at this point in the equation, and it may curl down. We'll give it another month to see what happens with Walmart. We're at the end of May. Some people say sell in May and go away. We're going to hold on and see what happens here. And so Walmart, there it goes. It crossed back over that 60. Now we're up to 62.75 and got a much bigger cushion. At this point, you've held it this long, you can now move your stop probably up to about $55 a share to assure yourself you get a profit, or try to assure yourself you get a profit at that one, and you still got half your capital running at this point. And so there's Walmart. That's a 1986 example, and we've gone into 1987. I've gone over my half hour. Will you guys give me a few more minutes to show you a couple more examples before we call it a day? I'm going to go to General Electric. And we're going to go, as soon as this populates, we're going to go to the date. It's going to be December 30th, 1996. So I went a decade further out just to show you how these ideas would work. And I went with a leading company of the 1990s. You can see the trend here without me drawing a line is upward on this one. It would have been one of the most popular stocks of the day. Then if I go to the S&P 500, let's see what direction it's going. Again, we've got an upward trending market, so you guys are going to be biased that you always have upward trending markets. You don't. You need to make that assessment and give it a red, yellow, or green light. And then finally, we're back to General Electric. At General Electric in this picture, I'm probably not going to buy this one until it gets to this this level, this 105 level. So we're just going to hold off and see if it'll hit 105. Again, because we only have $250 on this, we're only going to be able to buy 2 shares because of the high price of it. But don't let the price of a stock discourage you from buying it. And so we're shooting for the 105 price level, I think is what I said. And that would give us a 10% stop level of 90, say 95 roughly. And so if this stock doesn't buy at the 105, if it hits the 95, which it didn't right here, this is 95.88, we're going to rethink it if it would even hit that 95 level, but it didn't there. And now we're just seeing if we'll be buying 2 shares of General Electric as it moves forward. The market was moving upward, and we assume it still is. And so we're looking for a 105 buy on this. Hit 103 that day. On this day, it did. It bought. You would have bought your 2 shares on January the 14th. at 105, and you would have now had $210, so you would have $20 at risk to try to make 40 on this, 44 roughly on this example. So the stop would be 95. I'm just rounding the math here. And so we got 2 shares, and we're going to see what we do with this particular trade. Again, I'm running overtime today. I apologize for that. I'm just going to walk through General Electric and then close this thing out. And then if you have specific questions about this in the future, we can maybe do another show to circle back around to it. So we're in this at 105, the stock's down to 100, our stop's at 95. We're just sticking with the plan. We're not getting anxious because we had a drop there. We're just going to hold on and go day by day and see how this thing unfolds. It's part of owning stocks. You just got to let them wiggle and squirm as they do. And as this is moving slowly, I'll just try to not talk so much to fill in the dead air. Again, we got 2 prices. The 105 buy price, 21 points above that would be our goal. 2 times the $10 or $20, we'll say. 105 would be a 125 goal on the upside and a $95 stop on the downside. And we're just trading in between those right now. We're not doing anything. That's our range of what we're hoping to do. And we are just letting this thing unfold as it does. We're moved forward to the 26th of February. We bought this back in January, and nothing has really happened yet. We're just trading sideways. That's what stocks will often do for you. And they can change directions at any time, and that's why you need to put that collar on them. This one, again, is just not doing anything. It's just a stock in your portfolio that you're just allowing it to be a stock at this point. We look over here to the left on this one, you can see how it traded probably, this would be about 90 days where it had the same kind of action where it just traded sideways. That's kind of its personality. And as you wait patiently on this thing with your 105 buy point, you're just moving sideways just like it has historically. And again, that's the nature of this particular stock, or the personality of the stock. And that's the kind of stock you bought. This was not a up and coming technology stock. It was simply an old school company that was a technology stock when Edison invented the light bulb. But at this point, it was just a kind of what you would call mom and pop kind of company. So we bounced up from our 105 to a high of 108. Our 95 is our stop. We're getting close to it here on the 2nd of April, April Fool's Day. We are at a 97.75 low. We'll probably be paying attention to this thing to see how it responds, to see if we're going to get stopped out on it. But we're going to let it just stick to our original rules. It traded a little lower on this blue day right here. It only got to 97.13 was the low. And so here we go. We're just still trading sideways on General Electric. Sometimes these things can be like watching paint dry. And if that paint is drying and going in the proper manner, then you will have a beautiful picture at the end. And if you hit that stop loss, it'll still give you the opportunity for a beautiful picture, but it will be with a different name than General Electric. So let's see where this goes. We're now 90 days clearly outside of that, and it is back to our purchase price, which would emotionally tempt you just to get out there and say, I made a bad pick. But stay with your principles. See if you can get that $20 profit on this stock. We're up to 106. We've got a little bit of a profit in there, and we're just biding our time here. Clicked it 5 times to see if it'll give me all 5 here. There we go. We're up to 116 now. The goal would have been 125 to sell this out. Again, I'm having a hard time getting this thing populating. We're up to, here we go. We were trading at, on this day right here, I clicked through it too fast here. Let's go back, see if this will do it. I don't know. You guys, if you're having as much fun as me, you don't mind that we're about 10 minutes over. All right. This is a teachable moment for you, and then we'll move to close this thing out as soon as the screen catches up with my dialogue. So we're in 105, 125 is our goal, and 95 is our stop. And our computer is quasi-cooperating at this point. Let's try one more day here. Another day. Boom, here we are. We're at 116.50. Again, our numbers are 95 and 125. And stocks will do what's called a stock split from time to time. This one's getting ready to do a 2-for-1 split. You had 2 shares at $116 a share. The next day, the 10th of May, they did a 2-for-1 split. They gave each shareholder 2 shares. See this right down here? It says 2-for-1. It gave each shareholder 2 shares for each share it had and split the stock price in half. So you're right around that 116 level. So your goal will have to be split in half. 125 was your goal. It needs to be 62.50, and your stop would have been 95, which would have been 47.50 would be your stop price now with the split adjusted prices. So right now we had a nice boost there. We're up to, this would be the equivalent of the 120 level with our 125, but now it's 60 with a 62.50 goal. And we're just going to see what happens here. At this point, we've probably been in this long enough that we'd want to raise our stop price to about 55. That would assure us a little bit of a gain on this trade. And we may have hit the price right here to take our profit. $62.50 would have been the goal. We didn't hit it that day. And again, you want to make these decisions in advance so you're not getting greedy or fearful as the markets go against you. So this day we hit 62.75. If you did like our last trade and sold half of it out, you would have sold 2 shares at a 20% profit. You could have let the other 2 ride and maybe moved your stop to, you know, $57 a share or something like that, and just let this trade unfold from there. So that's an idea of how you begin to put your money at risk. We didn't put all $1,000 at risk in these examples today. We only put either 250 or 500 of it, and we're just working incrementally because you don't want to put all your money at risk when you don't know exactly what you're doing yet. You want to practice, you want to lead your portfolio by having those objectives, what your goal is, and what risk you're going to let it absorb on the downside. And so that's how you're going to go as you move forward in stocks. And these examples, I think, are good ones to look at. And again, we can do some more of these in the future, but start every trade knowing what color of market you're in, what color the stock is going in, and what is the risk that you have exposed. If you do that, you're going to lead well. Have a great day, and I'll talk to you all before long.